Hi everyone and welcome. It's Steve Johnson here, Chief Investment Officer at Forager Funds Management, and welcome to our September quarter webinar. We've just seen quite a few of you traveling around the country on our roadshow, so apologies if there's a little bit of repetition in today's presentation, but we will try and keep it fairly short. We've got about half an hour of content about the funds and some new opportunities and some old favourites leaving the portfolios, and then time for Q&A at the end of that as well. Before we kick things off, today's webinar is general advice only. We cannot and do not take your personal circumstances into account, and you should seek professional advice where necessary. It's been a very strong start to the financial year for the Australian fund in particular. We're up 15% to the end of September in that 3 months alone, and that 1 year return there is now 42% for the past 12 months. It was more muted in the international fund, about 3% for the first quarter of the year, but still a very strong 12-month return there of 23% for that fund as well. And for both funds, the longer term performance numbers looking very healthy there after a couple of particularly strong years. Look, we've been saying a lot over the past 3 years. It's been a pretty friendly environment for us. We've had small cap indices not performing particularly well, but some of our stock selection working across both portfolios and delivering some excellent returns. I would say in the past 9 months or so, that dynamic has changed. We've had a tailwind, particularly here in Australia, behind small cap stocks. It's been a stronger environment internationally as well, and particularly over the past 3 months, we've seen a lot of small cap outperformance. And you can see on this chart here, it's been a bit of a reversal of what we've seen over the past few years. The smaller end even of the small cap part of the market has done particularly well. You've got the World Micro Cap Index up more than broader indices globally. And here in Australia, we've seen a little bit of the same. There's some of the real micro cap stuff performing particularly well. So I'd say it's gone from an environment. We are going to talk as we go through today's presentations. There are still lots of really interesting things to be doing out there. There are plenty of parts of the market that are not participating in this rally, but it has become, I'd say, it's changed from a very friendly environment for us to one where the stock selection is going to get more and more important, and our discipline around valuation and opportunities is going to become increasingly important as well. It's an interesting environment. It's been this massive rally in the US at the big end of the market and really globally amongst small caps. There is plenty of stuff to worry about there, and I think there's plenty of signals flashing elsewhere in financial markets. And one of the big ones you can see here is that 30-year Treasury yield in the US. It has been high at around 5% for the past couple of years, and despite rate cuts, inflation coming down, talk of more rate cuts, that 30-year yield has stayed stubbornly high. I think that does reflect concerns about the fiscal position in the US. There is a lot of political pressure on the Federal Reserve, and I think legitimate concerns about the independence of the central bank in the US and their ability to act independently of the government. There's that. I think you've seen the gold price reflecting some of these fundamental concerns about fiat money and budget deficits as well. I'd say more recently it's become a meme of its own rather than fundamental concerns is driving that gold price parabolic over the past couple of months. But I think all of that started with some legitimate concerns about the state of the world out there, and yet we've got broad equity market indices rallying to all-time highs and trading what are at historically high multiples of their underlying earnings as well. So there are things to worry about out there. You're seeing us in our portfolios hold increasing levels of cash. As I said, I still think there's some really interesting long-term things to be doing if you're willing to go away from some of those more buoyant parts of the market, but it is a time for more concern than I would have had 12 months ago, that's for sure. All right, we'll run through some of the key changes to the international fund first. I've got Gareth Brown here with us today. He's portfolio manager alongside Harvey Magotti on the International Shares Fund. Welcome, Gareth. How are you?
Hi, Steve. Hi, everyone. Thanks for having me.
We'll kick things off with a performance update for the fund.
Yeah, so as Steve alluded to, a decent quarter in global equity markets, but more subdued than what we saw here in Australia. And then within that, we underperformed a little bit related to some stock-specific reasons, which we'll get into in a moment. Small caps generally did well versus large caps globally. It was really strength in the US that was the main driver there. And so it's not been as pronounced in places like the UK, Europe, and Japan. And nowhere moved as extremely as it did in Australian small cap land. It's a topic that Alex will touch on soon, I'm sure. And then the other thing there is within the large caps that generally underperformed the Magnificent Seven. The Magnificent Seven stocks continued to do very well. So a continuation of prior trends there.
If we flick to the top 10 holdings and the portfolio allocation by market cap, we've seen any significant changes here over the past 3 months?
There's been a few, but no, not massive. There's a couple of new ideas in there that we might get to in a moment. I think the main message I'd like to share here, that real broad spread. So by geography, for example, 2 continental European positions, 2 UK, 2 Japan, 1 Canada, and 3 US, and similarly along industrial lines. So there's a payments business there, there's a commercial aerospace business, a waste management, a bank, consulting and engineering, software. So just a good broad spread, and generally speaking, businesses that most people won't have heard of unless they follow us fairly closely. And then the right side of the chart, just a continuation of prior here, diversity via market cap. And as I hope that investors in this fund will be aware, a clear focus on the smaller end of town where we're typically able to find most mispriced opportunities.
Probably gone up a bit, that sub 5 billion, if you put those two bits of the pie together, and even the sub 1 billion part of the pie increased a bit over the past sort of 6 months or so. And from my perspective, it's something I like to see. I'm adamant that there is more edge available for us at that smaller end of the market. So good to see some increasing concentration down amongst those smaller stocks. Talk us through some portfolio news. It's been a pretty wild time out there with tariffs and world trade and all sorts of legislative changes impacting on businesses.
Yeah, I mean, it's been a volatile market. We've also had just a few stock-specific things. I'll touch on 2 of those now. Fiserv, it's been a difficult investment for us. This was supposed to bring stability to the portfolio, and it's not really achieved its aims on that front. Clover, which is a part of its business, that's the rapidly growing part of its business. It has slowed down, and that has got growth investors that were in it for that segment specifically a bit panicky. I think it's worth keeping in mind that revenue was up something like 30% last year on an 8% volume increase. So they're getting increasing revenue per transaction. So, a few things to worry about there, but it's still a rapidly growing business. The market's really skeptical of that second half for Fiserv. It requires a significant turnaround in H2 versus H1 in order to hit the management's full year numbers. Everyone's starting to panic that they might not get there, and there's a downgrade coming, and that's a big part of the reason why the share price is down. We are focused on the long run here. This has been a stellar compounder over growing EPS at 10% per annum over 4 decades. And it's cheap at 12 times earnings. So we're keeping our eye on the long-term prize there.
I think in a market that's very, very driven by beats and misses, whether a company's quarterly result beat what they put out there or not. I think Harvey said to me past this last result, I wish they just clean the decks here and set the expectations at an appropriate level and get back to what this company has done for a long time, which is beating those expectations that it's delivered to the market. They've backed themselves into a bit of a corner here. So that's an important result coming up in the next couple of weeks for the fund.
Yep. And then from one of our larger positions to one of our smaller, and I mean smaller by market capitalization, Nutex Health. During the quarter, a short report came out. It highlighted things that we have been aware of and have been somewhat concerned about. There was nothing substantial new in it for us. But then they delayed their Q2 results related to the audit, and that hit the share price, and it wasn't ideal. It's a position that we've trimmed very aggressively late last financial year. Honestly, I don't know exactly where to from here. We refer to these kind of positions internally as an up or out situation. It's cheap on the earnings. A few things fall into place. We may may well want to own more of this stock, but there could also be more disappointments ahead, and we may need to react to those. So flexibility to add or to cut depending on how news develops. And then I'll just touch on a couple of the winners or new ideas as well. So Zegona is a position that we own that's listed in London, but its business is it owns Vodafone in Spain. It's a special situation. This stock pretty complicated. We bought it about 6 months ago. Zegona acquired Vodafone Spain from the parent company Vodafone last year. They issued a substantial amount of preference shares to Vodafone, the parent company, in order to pay for that acquisition. These can be redeemed at cost. So it's a neat little feature here. It's sort of free optionality to Zegona. Management has merged the fiber assets of Vodafone in Spain with several other Spanish competitors, and it's freed up a lot of capital. They've taken more than 2 billion euros from that, and that's money that they can use to redeem the Vodafone preference shares and deliver a lot more of the upside to ordinary shareholders. The stock is up more than 100% since we acquired it 6 months ago, and it's probably closer to leaving the portfolio than being increased.
Interestingly, though, a very leveraged situation. You've got that note plus the debt of the entity itself and a pretty small slither of equity here when we first started. So that brings with it a lot of risk, but it also brings the potential for multiples of your money when things work out well.
Yeah. Yeah, it's been a good returner on a small position.
Yep.
Nice work from the team there. And then the other position I chose to highlight today is Inchcape. This is a new position. I think we might have started just in the June quarter acquiring it, but the position's been upsized a lot this quarter. It's a quirky business. So they distribute new cars on behalf of automakers in markets that are generally too small for the automakers to do it themselves. So they do sell Subaru here in Australia, but normally Australia would be too big a market for them. Chile is a really important market for them, the Baltic states, and then a bunch of smaller places, Singapore, Hong Kong, even quirky little places like Brunei. It's a cyclical business, but it's high returning business over the cycle, and it's probably less cyclical than most other parts of that automotive value chain. It's very cash generative, and importantly, I think management's nailing it on capital allocation here. The company's been buying back shares aggressively over the past 18 months or so. In just the past year, it's bought back nearly 10% of its equity base. So generating a lot of cash, buying back stock is a big part of the upside here.
Now, Bella's written a couple of really good articles on our Japan investments that are on our website, been up on Livewire as well. So I encourage people to go and read those. But it's worth touching on it here today. It's become a really important part of the portfolio. We had some great conversations with investors around the country. I think people are very interested in what's happening up there in Japan. So
Yep.
maybe we can delve into that today as well.
Yeah, this first slide in front of you, I think it's just an important indicator of the cultural change going on in the country. Buybacks last year nearly topped 20 trillion yen, which is an indecipherably large amount of money. But it's going to go close to topping that again this year, just up significantly on the past. The dividend plus buyback yield is running at about 5% annually, which is sort of double the level you see in the US, double the way Japan was, less than a decade ago. The stock exchange in particular, but also the government, have been really forcing this issue of modernizing and focusing on the G part of the ESG, putting a spotlight on poor performance, poor governance, and disregard for minorities that was really rife in Japan not that long ago. They are encouraging people to focus on companies to focus on unwinding these complicated cross shareholdings that entrench management, to not sit on mountains of cash too. And management teams are really falling into line, and it's something in the Japanese culture there that once that message is received, we're starting to see the dominoes fall. And on the flip side, the shareholders collectively are pushing their democratic rights, which is good to see. And foreign bidders, there was more than 157 takeover proposals from foreign bidders in the first 8 months of 2025. So it's a really good sign. This is not lost on the market. Like, investors are really taking note of this, but unsurprisingly, perhaps, they're really focused on the big end of town. And so we're not seeing a lot of competition in that smaller cap space that we are focused on, at least not yet.
We've put this table in a few reports. It's a very almost narrow focus within that improving governance theme on seven at the moment technology businesses in the portfolio.
Yeah. Look, part of the opportunity here, we had a great question about this on the roadshow. And part of the opportunity here is really these stocks don't screen that well. They don't look cheap at first glance, including on the table in front of you. They are all growing rapidly. Uh, Many are sitting on cash that is not adjusted. These numbers are not adjusted for the cash that they're sitting on that can ultimately be returned to shareholders. Many are expanding their profit margins. Some are going through a simple SaaS conversion. So that's where you go from selling like a 5-year software license to selling on-demand software by the month, basically. And so there's a bit of a valley there in terms of their revenue and profits get smashed in the short run, but it's really building quality earnings for the future. And it's a pattern we've seen in the US and Australia really a decade or more ago. I'll just pick on one here, eWell. It's a new position this quarter, so maybe worth highlighting.
New investment, that's your 10th use of position and you're out of credits.
Did I use position, did I?
Yes, you
Okay,
did.
new investment. I've been hanging out with Harvey too much. Um, eWell is an important investment. It's really a direct beneficiary of Japan's aging population. So a lot of businesses will struggle with this, but this is a direct beneficiary. The company provides SaaS software, so I mean pay by the month software, to in-home nurses in Japan. And this is a really big and growing field. The nurses are mainly looking after elderly folk in their home in the last decade or so of their lives. And the Japanese government has really realized over the past, years that it is both better service for the patient and quality of life terms and better on cost for a lot of these services to be provided at home rather than in hospitals. And so there's an increasing number of nurses doing this in Japan. And then eWell provide this sort of software to nurses that really help with all facets of their business. So medical records, scheduling, billing, compliance. And it makes those nurses more efficient and able to spend more of their working day actually helping patients rather than dealing with a mountain of paperwork. A lot of nurses still use paper-based systems, or they have simple Excel spreadsheets or an amalgam of various kinds of software. Of the companies that provide specialist software, eWell is the largest by a fair ways. So we have an industry that's growing with the number of nurses. We have an increasing penetration within that army of nurses to use a product like eWell. So we believe this business can grow really strongly for years yet, and the market, we think, is underestimating it.
There's been what I'd call a healthy pullback amongst some of these stocks over the past 3 or 4 weeks after a pretty strong run, which I think is actually good to see something of a pause there. This is a space we'd really like to be invested for the next 10 years. And these are not the only seven stocks in that ecosystem. There's plenty more on Bella's watch list of things that can come into the portfolio. So uh, more modest growth here over a long period of time would be a really good outcome and potential for us to keep recycling into new and different ideas within that ecosystem.
Perfect.
We've had this chart up for quite a few years, talking about underperformance of small and mid cap stocks. I think unlike here in Australia, that global large cap index is dominated by some companies that are right at the forefront of the craze for everything AI related at the moment. And the good news for us is that means this chart is still bouncing along at fairly low relative valuation levels.
Yeah, correct. So the small caps have historically traded at a small premium to large caps because they typically grow faster. Obviously, this is all relative, so this is not telling you small caps are cheap on their own. They're saying they may be cheap versus large caps. It's traded at a sharp discount now for 3 years. No substantial change from what we would have put up 12 months ago. If that reverted really quickly, we'd have a fantastic year. But as someone, I've got a lot of my money tied up in this fund, and honestly, I'm not sure that I want it to revert quickly like that. It's this kind of high dispersion market that we've touched on a few times, where small caps are cheap generally. Some pockets are doing really well, and others are becoming bombed out. It gives us a lot of opportunity to trade between things. It's a sort of environment that tends to work really, really well for us. So I'm really confident in our ability to outperform the broader indices if this environment bumped along like this for the next 5 or 10 years, or it could close the gap in a shorter time frame, and we'll make some money. So whether the discount closes quickly or whether it takes a long time or whether it even never closes, I think we're really well placed to generate good returns.
All right, thanks for that, Gareth. We'll move on to a place where the small cap rally's been a bit more violent and get you on here, Alex Shevelev. Alex, portfolio manager of our Australian Shares Fund. And Alex, it's been a pretty hot start to the financial year, both for our portfolio and for the Small Ordinaries Index as well.
It has, Steve. Hello, everybody. So, for the quarter to September, the fund did 15%, which we're quite pleased with. The Small Ordinaries Index also did about 15%. That was driven by 26% return out of resources and about an 11% return out of industrials there as well. A little bit different to what you heard from Gareth then. That's the in Small Ords performance is about 10 percentage points better than the large companies just over that quarter. A lot of that weakness was we went through reporting season. There were quite a lot of trip ups in the larger companies. So out of those top 50 large companies, 7 of them dropped by more than 10% on results. Companies like James Hardie that you would have heard of. I think broadening out though a little bit over the last year, we're really pleased with that result there, 42% for the fund. That's significantly above the small and the all odds there. And if we go back since inception, this is now more than 15 years for this fund. It's well and truly about double the return of the Small Ordinaries Index and a good 250, 300 basis points above the return of the All Ordinaries Index as well.
Looking at the top 10 at the end of September, there's been some pretty significant change in this portfolio, and I think that's a very healthy thing to see given the returns over the past few years.
That's right. We've had a period of a fair amount of change in the portfolio, including in the top 10 here. So you can see the largest investment at the moment is Cuscal. We might talk about that a little bit specifically later on. There's some good news there out of results and an acquisition that we'll touch on. Even at the end of September, for example, we had Bravura that was the second largest. That is actually a much smaller investment now. We got an upgrade to earnings out of that business, which was really great to see. Drove the price higher to levels where we were more comfortable reducing our investment there. RPM.
Maybe just before you move on there, Alex, it's a fascinating insight into the, I guess, what I'm calling the momentum-driven nature of the current markets. I mean, its actual result delivered in August was a very modest downgrade. The share price was down, what was that, 15 or 20% on the day?
Significantly, that's right.
Yeah, under $2 a share, and then they're out with an upgrade leading into the AGM, and the share price is $3.40 a share just a couple of months later. Well, I don't know how much you're changing our numbers by on some of those news, but it's certainly less than 10% in terms of our view of the value of the business in both directions. We've seen these huge share price movements, largely driven by momentum and people that don't want to be in a stock that's going down.
Absolutely. It's been a very volatile stock given the quality of the underlying revenue and the trajectory of the cash flows there. It's been quite volatile. Now, RPM Global is one I think our investors have probably heard quite a little bit about over the years. It used to be the fund's largest investment. It's being taken over here by Caterpillar, which was sort of the eventual plan for quite a while with this business to sell it to a large trade buyer, given the quality of revenue there. After 6 weeks of due diligence, that deal is now firmed up, so hopefully completes sometime in the new year, which is good to see. And then a new entrant in this top 10, IDP Education. We'll touch on the full thesis a little bit later on.
One big name missing from that top 10 chart that's been there for a very long time in our portfolio is Catapult.
That's right, Steve. So Catapult has had a pretty amazing transition from quite an unknown stock 2.5 years ago to an ASX 200 stock with big bank coverage. And we just wanted to talk a little bit about the life cycle here of that investment. It was very meaningful for us. It contributed about 12% to the 2025 financial year's results. And you can see they're just starting off quite early. We actually started this investment near $2, and you can see the first 12, 18 months when we didn't see share price appreciation. In fact, the share price was well and truly down over that period. We kept a reasonable weighting throughout that first 18 months, about a 2 percentage point weighting. That meant that we were adding at some, in hindsight, very, very attractive levels. There was a period, though, subsequent to that, where the thesis that we had started to become more obvious, a little bit more proved up. The revenue growth continued, the cash generation started to kick in. And as that was playing out, we weren't the only ones to notice that, naturally. So others were able to notice this too, but it was sort of the early stages of this thesis confirmation. And so we took that opportunity to, again, increase our weighting despite it being at higher prices. It had been a very good performer since then, but we are valuation-driven investors, so there is a point at which we step away and wind back the investment. Given this was about a 10% investment in the fund for a good chunk of 2025 financial year, we started winding that back quite meaningfully. We sold the remainder of that stock in and around the time when it went into the ASX 200, so the top 200 stocks. That was a very significant transition from where we started in valuation terms, in liquidity terms, in attention terms. So it was really good to see that cycle, and probably a good example of just maximizing the profit from a pretty successful investment. So now we're on to finding the next catapult.
I'll just add to that, Alex, as well. I think the minimizing the risk part of that is really important as well. That 2% weighting here, it was not certain at the time we first invested in this stock that it was going to go in this direction. It was going to end up in the ASX 200. There was a lot of water that needed to flow under the bridge there to prove up that thesis. And you are going to see more and more of this invested with us, fairly small initial weightings. We've got a contrarian thesis. We're going against the market. As we get evidence that we're right there, really focusing on capturing as much of that, the upside from the successful ones and more than we have caught before, but while taking on less risk in those initial stages. And I think really importantly here, our discipline around moving on from things. And we are in a market where people are paying very, very full prices for the right sorts of businesses. And it's important that we are completely out of some of these investments and on to the next opportunity when those prices are no longer meeting the required returns that we need from a stock. Elsewhere in the portfolio, some new and older opportunities here.
That's right. So Cuscal is actually an addition to the portfolio in November of last year, so getting a little bit more established in the portfolio. It's a payment infrastructure business. It's now the fund's largest investment. They, with the 2025 financial results in August, did a very good deal buying a large competitor of theirs. Now, that is a deal that's going to add 25% to the earnings per share of that business after synergies. These take a little bit of time to eventuate, but when they come, it's going to be very, very impactful. The full result itself was really good. It was a 16% increase in earnings per share, 5% better than what they had spoken to at the prospectus, which was really good to see. And importantly, it feels like Cuscal is in the very early stages of being discovered by other buy and sell side participants in the market. It's a stock that has some quite interesting characteristics, very recurring, stable top line revenue flowing through to quite impressive low double-digit organic earnings growth. On top of that, we're going to have this acquisition that hopefully really elevates it in the eyes of the investment community. There's another stock that we've been a shareholder for much longer. That's PeopleIn. This is a recruitment services business. Now, this was a pretty difficult full-year result for the business. Revenue was down about 6%. Profit was down about 10%. It's been a pretty muted environment for all things recruitment, and especially for PeopleIn. One of the highest margin elements of their business is permanent recruitment, especially for IT professionals. That's been particularly muted over a couple of years now. The business also had a bit of a debt problem if we rewind 12, 18 months, but it's had very healthy cash generation, and that cash generation has paid that debt down to a level where I think people would be a bit more comfortable with that level. In the 2025 financial year, we saw maybe the first early stages here of green shoots, a little bit of commentary around the existing businesses, and a bit of commentary around the upcoming Olympic Games. They're a Brisbane-based organization as well, and perhaps some defense work around the country too. Corporate travel is another investment of ours, a travel management business here. Now, we bought this in late 2024. There's some disappointments around the European contracts and some macro concerns around business travel at the time. Since then, they've done a good job in winning new contracts, but had some issues with the US tariff-induced travel shakiness as well. Broadly, though, that had been share price was up from our entry point and had been working out more or less according to the thesis. Unfortunately, in August, the business went into halt. That same European division, which only makes up about 15% of the revenue of the business, will need a restatement in earnings. So that's disappointing. It is a non-cash item that we've been that they have talked to. It is a shifting of earnings from the 2025 financial year into earlier years, it sounds like, but we're still to see the stock trade. And as a result of that, we've taken a 15% haircut on the share price as it stood when the stock stopped trading. hipages, another interesting business in the portfolio. This is an online tradie marketplace. Revenue growth here was about 10% for the 2025 financial year, but importantly, half of that revenue went through to free cash flow. That is really, really strong operating leverage. There's a new platform that those tradies are now on. That platform over time should reduce the churn, that is those tradies that stop using the platform, and increase revenue further. They only had 1% growth in the number of tradies on the platform. The rest of that growth was price. And so reducing that churn is going to have a nice positive impact on revenue growth in future. And over the long term, revenue should continue to drop through at pretty high levels into profitability and cash flow. They've actually given a 30% cash profit margin goal over a long period of time here, which is really good to see.
Now, Alex, what's been a pretty buoyant market, there's been no shortage of fallen angels for us to be picking over for the next opportunity. We've been talking a bit about this internally. I do think you need to be careful in these sorts of environments about the beaten up stocks when everyone's optimistic. Often the beaten up stocks are beaten up for a reason. We've been looking at Domino's Pizza and Reese, and there's quite a few previously well-liked companies whose share prices are down a long way. One we have pulled the trigger on, though, is IDP Education, and that's a particularly interesting new investment in the portfolio.
Absolutely, Stephen. Fits the criteria of a fallen angel very, very well. Now, IDP, it connects students with universities. So in Australia, Canada, and the UK, these universities would go to IDP to source international students for them. And they also co-own the IELTS English testing system for high stakes testing around the world for education and immigration. Long term, it's been a very impressive business. This has been into the 2024 year at least. They had compounded about 20% growth over a very long period at their net profit line. But in 2025, it was an absolute perfect storm for the business. So government restrictions came in, clamped down on the volume of student placements in all of the markets that they operate. And that had a flow-through effect into the IELTS English testing business as well. Profits were down 58% during the year. Worth rewinding a little bit, there were record international student numbers post-COVID, and that caused some housing pressure and some political pressure in all those jurisdictions. That prompted government caps to be imposed and enforced. But we talk about international students, that education element's pretty strong export market for Australia. And at the very least in Australia, we've seen the first indications that that policy has started to be normalized, at least loosened a little bit. So the government came out in August and said that there would be a 9% increase in the cap. And so that has happened in Australia. We're yet to see that in other jurisdictions, but it bodes reasonably well for numbers in at least domestically.
I think the price got down to a level here as well, where with some cost out help, you don't need a dramatic recovery in student numbers for this investment to work out okay. But chances are you're going to get it over a longer period of time. The timing is uncertain, but I think the reality over longer periods of time is most countries are going to want more international students and all of the money that they bring.
I think that's right. And this is one of the interesting elements here. The business has managed over time to both take share because they're quite a high quality and large provider in the space. And the universities have increased prices and IDP has also increased prices. And so all of that has combined to improve over time profitability from a given student. Now it's quite a fixed cost business. They're in a position now of reducing those fixed costs. So we're likely to see $25 million less cost this financial year. So that's a 7% reduction on the back of a 5% reduction the prior year. And I mean, the share price is up, let's say 80% from the trough here. We started buying some time ago, but it is still down 50% or more from 12 months ago. And this was a market darling, $40 stock in the absolute heyday, now down to about $6.50. So we think it's very attractively priced. There's a recovery that we believe happening on the earnings side, and it's actually quite a high quality business once that government policy starts to normalize.
It's also a decent sized business with good liquidity in the stock, and I think that's the right sort of thing for us to be adding to the portfolio at this point in the cycle as well. So thanks very much for that, Alex. We'll jump onto Q&A now. So you can just hit the Q&A button on the Zoom webinar and start entering your questions, and we'll gather those together and start answering them for the next 10 minutes or so. Gareth, I might just kick off with one for you just on US equity markets in particular, with everything that's been happening over there and the portfolio's exposure to that. Are you worried about that exposure to that part of the world, and any views on market levels there?
I'm worried about all our exposures to all parts of the world. So it's not alone there. We are underweight the US versus the indices that we compare against. So we have taken a view that there's better value elsewhere. Obviously, that position is not zero, and it will never be zero. The US is a massively important market. It is about finding things that we are comfortable with, despite there are pockets over there we are worried about. So Fiserv at 12 times earnings is a big position for us. We don't own Nvidia. That's a big part of the defense. The other is that we do own less than the indices and have more money elsewhere in places like Japan. We're overweight in the UK as well.
Alex, question for you. Do you own any healthcare stocks in the Aussie fund? A couple of suggestions for Telix and Mesoblast in the question, and views on that space.
Yeah, we don't own those two stocks. We do own some investments in that space. One, which we can highlight, is a company called Aroa. That is a pretty interesting business that uses a byproduct of the sheep in New Zealand as a device for the US healthcare system.
Not just one sheep. I think they
No, not the one. It's a unique business, I think, because the way to market there can be quite expensive. And when the business first got going, it used a distribution partner in the US. That relationship has been quite healthy. It has disappointed at times with respect to just how quickly it will grow, but it has been a very impactful one. It's profitable on that revenue stream alone, generating quite significant amounts of cash, but with other of their products building up distribution in the US as well. So that the business there is going to be growing the top line in a very healthy fashion, and we should hope to see over the next couple of years quite a disproportionate amount of that dropping through to profitability as well.
And Nanosonics is a very big or meaningful investment for the portfolio as well, sort of equipment, but tangentially related to that space. And you and I have spent a fair bit of time looking at and thinking about that healthcare sector over the past few months. It's been one of the worst performers over the past few years. It's a defensive sector, and if the economy takes a turn for the worst, you'd think those sorts of stocks are going to be in favor. I'm still finding it pretty hard to find good value amongst some of those businesses. It's been a very long tailwind in this country of prices for their services going up faster than cost of labor. And we've seen that trend reverse over the past few years, and I'm really unclear as to whether they are great businesses or whether they've had a really nice tailwind over a long period of time, and they're not yet trading at prices where you don't need to answer that question. So it's a space we're spending a lot of time on. Even some of the big players, Sonic, Helios, post demerger, there's a nice clean pathology business. So there's lots of interesting stuff to be looking at. It is part of our portfolio and might be more with a bit more pessimism about it. Gareth, you had a question about Motorpoint, which has been a long-held stock in the international fund, and a trading update out last week.
Yeah, we missed a big opportunity to trim this position back in the bubbly years, 2021, that time. So we've held it, I think, since 2019. Did really well for us, and then it's been a much tougher environment the last few years. We're coming out of that now. It's a very, very well run used car retailer in the UK. I know it well. It's a business that can grow in terms of the number of sites it has. But it hasn't been. It's been a very tough environment. They specialize really in clearing big inventory. So things like short-term car hire companies would come to them and say, I've got 1,000 lots of this. They move it very, very well. The customer gets a good price. That's been their specialty, and COVID really blew that whole segment up for a few years. We think it can be a good outcome from here. What would really make it pop is lower interest rates. They make good money from financing packages. So someone will sign up with Black Horse, that's a division of Lloyd's, for example. And historically, something like 55% of people would take a loan when they bought a car through Motorpoint. That's dropped off because the headline rates have been quite high, 11.9%. A little bit lower interest rates would allow them to sell much higher than they are at the moment. They're sort of down in the mid to low 40% penetration rate on finance, and that's a really good volume stuff. So yeah, I think the bull case here is we get lower interest rates. We think it can do, relatively well in a environment that holds interest rates steady. But yeah, it's just we think a good compounder, although, as history has shown, can be very cyclical.
A couple of related questions here that I wouldn't mind you both having a crack at. One sort of says, how's the portfolio land soft if the US goes down, or what can investors do to protect against that particular part of global markets performing poorly, given it's so big? And I would add to that, connected to the rest of the world. And then, do you see discounts of small and mid caps versus large and mega cap stocks assist or protect you in the event of a market correction? I thought maybe those two are quite closely intertwined here in terms of how I think about it.
Yeah, do you want to
Should we
keep
go
going?
first?
Yeah, very kind. I'd say to that second point more than the first. I think the part that we look to in the portfolio is we have investments there that have quite idiosyncratic drivers. So we'll use one of the examples. We've had a question come through about EML as well. That is a business that, yes, will be dependent on various market factors, but is really dependent on, can they get their sales force right? Can they sell another small $10 million odd increment of revenue every year at reasonable margins? that's going to be the deciding factor there, not necessarily the performance of the US or sort of other jurisdictions around the world in a broad sense. So we look at the idiosyncratic factor to try to, if you will, protect us from some of that over longer periods of time. If we get more right on that side than wrong.
The second part of the question there, Steve, it depends on what the downturn looks like, right? There's many possible types of downturn that could be in the future. I think I can see a world where something like the world reckons there's been big misallocation on artificial intelligence, for example. The Magnificent Seven disappoint. Everyone starts going, oh, some of these value stocks are pretty cheap, trading at 7 and 8 times earnings, and plow into that. So that could work very well for us. Also, whether that's going into value stocks or going to smaller cap stocks. But then there's also the kind of shocks that can hurt economies, and we own some stocks that look cheap, but then their earnings can get hit as well. So we try to we hope we're in a position where we can outperform into a downturn, but it's really going to depend on what the downturn looks like. I'm not sure I addressed the first part of your question there.
I think that's fine, Jay. I think Alex handled it pretty well. I think everyone who's invested in this fund, both of them are small and mid cap funds. I don't think you should expect over a short period of time to be protected from a downturn in funds like this. I think particularly in the Aussie fund, if you add up the cash and the stocks that are currently under highly likely takeovers, that cash level's quite elevated at around 20% of the portfolio at the moment. In the international fund, our ambition here is to be significantly better placed than the last time around, and to make sure that we're in a better position to take advantage of the opportunities to come along. But I wouldn't expect, and we live in a more correlated, I think, world financially than we've ever lived in before. So do not expect for things not to go down in some sort of market crash or correction. And I think if you're invested with us, you should be hoping that it happens. We want to be able to put money to work in panicked market environments. I think we're well placed to be able to do that. And you may cop some short-term negative performance that you see in the funds, but it will be the sorts of environment where we're putting a lot of money to work and setting ourselves up for the higher future returns. So I think everyone is invested with us. If you're thinking long-term here, you want to be crossing your fingers for more volatility rather than less. Alex, well, maybe just time for a couple more here. There's a question you mentioned earlier. The gold stocks have been a particularly strong driver of that Small Ordinaries performance. Is there any exposure to that in the portfolio, and do you think it's run too far?
I won't make a comment on whether it's run too far or not. I did see people queuing up in Martin Place this morning trying to get their hands on some physical gold, which is maybe a sign of the times. In our portfolio, we're not directly exposed to gold. We don't have any actual gold miners in the portfolio. We do have a small investment in McMahon. They provide mining services for, amongst others, gold companies as well. We used to own Parenti, but that's sort of the context of our exposure in that space.
Yeah, and I think in general we want to own businesses where we're confident about the valuation of that company, and where the main inputs into that valuation are something that we think we have some capacity to forecast. And I think across the whole mining production space, we find that pretty difficult. There's a question here about what you see as the market response when corporate travel begins trading again. I mean, we've sort of, I guess you can take from the haircut that we've taken to the valuation, we've tried to take some sort of estimate looking at what has happened previously in similar sorts of situations, but that is completely going to depend on what the announcement looks like and includes, and how the business is trading over the first sort of 3 months of this year as well. We're seeing some pretty positive tourism and travel related data elsewhere. So it might be a combination of we have to restate some prior accounts, but current trading is pretty good. It might be worse than that. So the 15% is our best guess at the moment, and we just need to assess it once the news actually comes out. Okay, I think with that, we'll wrap things up. It's 10 to 1 here in Sydney already. So thank you everyone for tuning in to today's webinar. Enjoy the rest of 2025, and we'll be back in January 2026 to do the same again. Thanks a lot.